Monday. Welcome to Monday Minutes. Interesting since the Fed meeting, basically ruling out 75 basis points. Admittedly, we were quite surprised that he would rule out anything at this point. When you look at the range of outcomes with inflation, a lot of talk about peak inflation, but there are outcomes potentially the other way too. So we were surprised by that in and of itself. Certainly, the market now taking some premium out of the rate hikes short term, and we have seen a steepening of the curve. And the market saying, well, look, I mean, if 75 is off the table and this appears to be the cadence, we're going to, and that somewhere else has been the back end of the curve. We've certainly seen now for quite some time the Fed buying going away. What that means over time, increased volatility, and certainly real yields now on the rise in 10-year space. And we've talked a lot about this, the need for real yields to normalize the rate structure here, normalizing somewhat. With regard to the yield curve, certainly volatility positions come into play. Did the curve belong inverted? In our estimation, no. So extremes, but this is an extremely. We have priced in a lot of interest rate risk across the globe, and certainly here in the U.S. Now, we've pointed to context, not that this is 2018 per se, but we have in terms of rate hiking cycle where the Fed went to theoretical neutral, which the chairman says neutral is a concept, so we don't really know between 2 and 3%. So let's call it 2.25, maybe 2.5. The Fed in 2018 getting close to neutral, and then ultimately financial conditions tightening and the market breaking down, creating a pivot in 2019. So will this be a repeat? It remains to be seen. But the markets right now are clearly extremely fragile across the board. We look toward the mortgage market in general, moving rates within a short period of time over 200 basis points. There is a bit of paralysis with regard to those markets. So short term, the Fed is pushing back against this notion of an even bigger outsized move in terms of rate increases. We heard from Richmond Fed President Barkin, who said everything's on the table. Certainly Fed Governor Waller and St. Louis Fed Governor Bullard falling in line, I think, with the chairman's sentiment of 50 basis point moves. And then this morning, Atlanta Fed President Bostic saying he didn't see the need for moves beyond 50 basis points. So it seems more than likely that 50 is certainly in the July. We'll have to see what the data brings. And certainly this week we'll get another CPI print, PPI print will lead the way in terms of data. And right now, short term, we know it's all about inflation. As the year evolves, though, it's certainly the growth side of the equation is certainly in terms of the cadence of. It's pretty clear. If we move from 50, it doesn't. So how that shift occurs has implications for outright yield levels, certainly implications for the yield curve going forward. On the ground this week, like I said, it's CPI and PPI, and then lending into the steepening theme that Treasury's quarterly refunding in the form of 3-year notes, 10-year bonds, and long bonds. And the market clearly will be watching the sentiment and the numbers with regard to demand, given the repricing that we've seen now, and given nominal yields in 10-year space well north of 3%. Wishing everyone a great week. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities.